Welcome to Coal Nation, the official podcast of the American Coal Council. Join us as we dive into the critical conversations shaping the future of coal. From industry experts to policymakers, we're exploring coal's essential role in America's energy, economy, and global trade. Whether it's powering communities, driving innovation, or securing strong global economies, coal is at the heart of it all. ACC, proud to be American, proud to be coal. Coal Nation starts now.
Welcome to Coal Nation, the podcast of the American Coal Council, bringing you insights from across the coal value chain and the people shaping its future. I'm Bill McFadden, and I'm stepping in for Emily Arthur today, and I'm excited to be your host for what is a really important conversation. Today, we're joined by Dave Rossiter of Vitol, one of the world's largest independent energy and commodities traders. Dave brings a unique perspective, having spent his career on both sides of the table, from steelmaking and raw material procurement to global coal trading and investment. In this episode, we're going to dive into the future of metallurgical coal, the growing demand for steel, and why companies like Vitol are making strategic investments in the U.S. coal market. We'll also explore how relationships, technical expertise, and long-term partnerships continue to shape this industry in a meaningful way. Before we get started, I'd like to recognize our sponsor for today's episode, Navajo Transitional Energy Company, NTEC. NTEC is a proud member of the American Coal Council, powering economic growth with dependable energy when it's needed most. To learn more, visit navenergy.com. Hey, Dave, thanks so much for joining us on this podcast today. I really appreciate your participation in the Miami Coal Forum as well, and Vitol's overall support of the ACC.
Thanks, Bill, and thanks for having me on. It's a pleasure to support the ACC, and certainly a pleasure to attend the conference recently in Miami. I think it's been great to see the growth in the American Coal Council, and in terms of its membership and the work that they're doing in putting coal on the map or back on the map in some cases. So happy to support.
Yeah, and look, we're really excited about Vitol's investment here in the U.S. Mining industry. But before we kind of get into that and dive into that, maybe please take a little bit of time and give us a kind of an overview, an introduction of yourself and your background, and sort of how you got to this point of being a guest on the Coal Nation podcast.
Yeah, sure. Look, I think you and I have known each other for a long time, Bill. I guess we first came across each other probably more than 20 years ago now, and our careers have had a very similar trajectory in terms of the things that we've done. So I grew up in the UK, studied French and business studies at university, and I had this romantic notion of wanting to work in industry as opposed to just working in an office. I guess probably a step back from that, I had an uncle who worked in a power station as a chief engineer. And as an impressionable teenager, he took me there and took me around the plant. And the kind of scale and scope of it made me kind of more hungry to move into the industry side of the business. I graduated in the year of 98, 99, and started my career at British Steel, the original British Steel. I spent in total 11 years in the steel industry, went through the transitions from British Steel to becoming Chorus and then Tata Steel, initially working in steel marketing and sales, and then moved into raw material procurement, covered coke, then ferroalloys, and then met coal for the last 5 years. Then I left and moved across the table and started working for mining companies. So I spent a number of years with West Farmers Coronado, I worked for M Resources, and then joined Vitol back in April of last year. So, yeah, coming up on a year already. I'm not sure where the time's gone.
Yeah, and you're right. Just for the audience, should know that, yeah, Dave and I have known each other since, as he said, probably the early 2000s. Our careers have been intertwined. Like Dave, I was a buyer of steelmaking raw materials and metallurgical coal for United States Steel Corporation. Did that for a number of years, and even back then, we intertwined because this industry is awesome, and the railroads and have provide opportunities for buyers to get together and sellers to get together. So we probably met each other, I'd say, I don't know, 2007, 8 on that circuit. Like you, I flipped over to the other side of the table and went from being a buyer to a seller. And I was responsible for selling about 8 million tons of metallurgical coal, coking coal. And at that time, you were a buyer with Tata. And I just have a great memory of, say, it was back in 2011, the Oak Grove mine, which is in Alabama, and I was responsible for selling that coal, was hit by a severe tornado. And it was a pretty down time for our company. And, we were excited. We just made a big investment. And here you come along, and you and your colleague from Tata at the time, while there was still a lot of wreckage there and a lot of work to be done to get that mine back and running, signed a term contract for a significant volume of coal, and that really put a charge in us as far as wanting to get going. And I remember that to this day, and I really appreciate that.
I think that's important. I think you've hit the nail on the head. This is very much a relationship industry between individuals, but I'd also say at corporate level. We'd had history in Tata Steel of using that coal from Oak Grove, and we'd had a long relationship with the asset previously. Then there'd been a bit of a gap, and we could see that. The mine was struggling, but fundamentally the coal was a fantastic coal. Yeah, we were very happy to partner up and appreciate the support with the term contract. And I think just one of many stories where you kind of have people that follow you through your career, and sometimes you're buying from them, sometimes you're selling to them, sometimes you trade in between each other. But it's a fairly unique industry. I think the kind of raw materials industry in that sense.
Yeah, we've also found ourselves working together for a time. Yeah, we were right now. Currently, I have my own company. It's called Deep Creek Resources. But for the last almost 5 years, I've been sourcing metallurgical coal and working through a company called Visa Commodities. And when I first made my decision to kind of get into that arena, Dave was with Visa Commodities, and we had a lot of talk about maybe me coming on board and joining and working with Dave and my other colleagues from Visa. And yeah, so we were connected for a year and a half in that capacity, and Dave has visited my home, and we know each other quite well. And yeah, our friends. So this industry really does have a way of connecting people, and you form really lifelong lasting friendships in this business.
Yeah, for sure. I think, look, if you're working 9 to 5 in an office, it's very easy to hide your emotions day on day. But I think, if you spend time in the trenches, and certainly if you spend a lot of time on the road with somebody, and you're having 3 meals a day and sitting in cars for endless hours driving the mines in the middle of nowhere, then you really can't hide your true self, and you find your friends very quickly, and then they become friends for life in a lot of cases. So yeah, it's been a privilege to work with you, Bill, but an even bigger privilege to be friends. And yeah, thank you for taking me skiing on that beautiful mountain out the back of your house there.
Thanks. Um, yeah, and just a little bit too. So the audience is not as fluent, I would say, in steelmaking raw materials and metallurgical coal, and the importance of metallurgical coal in making steel as we are. Like you, I got bit by the kind of the phenomenal importance of metallurgical coal in steel, and obviously we all know how important steel is to our economies. And so I got bit by that bug, steelmaking raw materials, metallurgical coal. And maybe you can talk a little bit about that and how you see metallurgical coal and the thesis for investing in metallurgical coal and being in that business from your perspective, and maybe dovetail that into Vitol. And obviously Vitol shares the same opinion, and maybe you can kind of take us through that.
Yeah, so I work for Vitol. Vitol shares a similar belief on met coal, and the future of met coal. Vitol, for those who aren't familiar, is a global energy and commodities trader. We're actually the largest independent mover of energy globally. We move around about 540 million tons of oil equivalents per year, which is the metric that we use as a sort of baseline. We move about 7 million barrels of oil a day. We've been around now for 6 decades this year, so we've actually got a birthday coming up this year, which is quite a special event for the company. We've got four primary business verticals. We have oil and refined products. So we have transitional energy, which includes things like LNG, LPG, carbon, natural gas. We have a sustainable energy leg as well. We do a lot of things there around sort of biofuels. That's had very, very heavy investment over the last few years. So we've invested about $2.5 billion into that leg of the business. And then a couple of years ago, we branched out. We Under the sort of carbon banner, we already had a thermal business, but we moved into metals and then also into sort of mining and steelmaking raw materials. On the metal side, we were very active in aluminium, and on the steelmaking raw materials, we developed an iron ore desk. We acquired Noble Resources back in 2024. And then we moved into setting up the met coal desk back in the early part of last year. And yeah, I think from our perspective as a trading company, we do all of the things that trading companies normally do. So we can risk manage, we can support with financial management, we can move physical products, screen trade. We've got a global network in terms of infrastructure and infrastructure support. And the feeling was that those products under the metals banner dovetailed and fitted very well with the existing portfolio that we had. And certainly, on the raw material side, the view is that met coal sits very nicely alongside thermal coal, given the overlap with some miners and some end markets, and it fits equally as well with metallurgical coke and with iron ore.
Yeah, thanks, Dave, for that background. From my perspective, as somebody who's been a participant in this industry for a long time, just the fact that Vitol has stepped in the metals and steelmaking raw materials space is enough for convincing me that metallurgical coal is or should be enough for convincing anyone else that metallurgical coal, steel, metals are a very good investment prospect. And but this thesis is the world is growing. We need more steel. We need more steel making raw materials. Just so everybody knows, and Dave, you just mentioned it in your previous comments. I mean, in a developed economy like ours in the U.S., I imagine the same is for Europe as well. About 70% of the steel that's produced is made from recycled steel, scrap metal. Steel is one of the most recycled industries that we have. But in the developing world, in places like India, China, for a long time, and we're going to get into these different markets hopefully if we have time. It's kind of the other way around. And the large majority of the steel that's produced is still produced by digging iron ore out of the ground, by digging metallurgical coal out of the ground and making coke. And steel making raw materials represent about 70% in those environments, about 70% of the cost of 1 ton of steel. So as these countries grow, the world is going to need more of these mined products to enable these economies to develop, to build buildings, build roads, build bridges. And for that reason, I see that the thesis of investing in this industry is very solid.
Yeah, for sure. I think, look, we certainly support that, and I personally support that. I think electricity generation through coal-fired power stations is still a low cost and efficient way to do that. I think you've got to manage that in a sustainable and careful way, but economically, it makes a lot of sense. Similarly, with steelmaking technology, it takes a while to generate sufficient scrap to have scrap resources to go down the electric arc furnace route. Certainly, as we see rapid expansion in India and Southeast Asia, the focus is still very much on integrated steel production.
Yeah. Look, yeah, let's now focus a little bit on the investment, if you want to, on the investment that you made here in the US. And maybe you can talk a little bit about that. And there are probably lots of other opportunities to invest in mining complexes around the world. I'm sure Vitol was looking at others, but you actually came in and did make an investment in a mining complex here in the US. We're very happy that you did. But maybe just talk a little bit about that, and also kind of your view on why the U.S. Metallurgical coal mine is a good investment.
Yeah, so I think from Vitol's perspective, we have a strong balance sheet, and I think if you look at the three other verticals outside of metals and mining, we've had a strong track record of investment in assets. There, we've had a combination of equity and debt plays. I think there's an acknowledgement that the metals side of the business is new to us. we're not a significant player in the same way that we are in those other pillars. It's a growth market for us. It's been very successful in its early years in terms of that growth, but the focus has been much more on debt financing as opposed to equity. We don't want to own mines and run mines, and we recognise that you need to stay in your lane on these things, and that there's people that are better positioned to run coal mines. From the debt side, there's a number of different things that we can look at. So those can be fairly vanilla financing in terms of things like prepayments, and in terms of extended financing, and then we can look at much more structured debt financing that can be linked to supporting assets in terms of restructuring, or in terms of acquisition financing, which is the case with the case that you're alluding to. So Vitol has the ability to invest or to finance on its own, or to work with other financing options. And we also have the fund, which is called VMP, and that fund is managed by a company called Breakable Capital, and Vitol's the sole lender into that fund. And we've made three moves into the North American market. So the first one was some restart capital for Allegheny Met for the project there. We then pivoted from that, and we debt financed the Eagle Summit Resources acquisition of reflectants. And as a quid pro quo, we entered into an agreement with Mike Day and Eagle Summit Resources to manage their export marketing. So I now work very, very closely with Mike and his executive team on the export side of the business. But far deeper than that, we're also very, very closely involved across the whole commercial portfolio with domestic as well as export. From Vitol's perspective, we'll assess any opportunity standalone if it makes sense to finance, but the preference is very much to support the trading desks. And so if we see an opportunity to invest and support the desk in terms of physical flow, then that's much the preferred option. In the case of Allegheny Met, that was a little bit different. The opportunity wasn't there to do that, but certainly with the Eagle Summit Resources financing, then we were very, very happy to move into that and to build a beachhead with Mike and around the US business. My personal view is there's still a degree of fragmentation in the US market, and there's opportunity to invest and to really build a strong base. So we've also looked at logistics. We've recently taken a port throughput agreement. We've been in discussion with the railroads as well to support that. And then that opens up a lot of other opportunities. Why US versus other markets? I think if you look at Canada, for example, it's a very consolidated market. It's big in terms of volume, but it's very, very consolidated in terms of just a handful of producers. If you look at Australia, a lot of the Australian miners are large listed companies, or have recently gone through structural changes and have been supported by external money, and some of that's come with tie-ins on marketing. And so I think the other thing that you tend to find is, because of the nature of the Australian market, without having a domestic market of considerable size to supply into, they've always exported. And so it's very difficult to find a customer that's not familiar with most grades of Australian coal. I think what we've seen over the last couple of years is we've seen the growth in demand from markets like India, Indonesia, other Southeast Asian markets, and China. There's not the same level of familiarity with US coal. And so that presents opportunities to work with US producers and look at things like new product development and new market development. And that's something that I spent the second half of my career to date doing, and it's something that fits very well with the ethos of Vitol about working very closely in collaboration with producers and customers, and really adding value through the supply chain, whether that's physical, financial, or indeed any other means.
Yeah, it feels very complimentary. I mean, you've got the guys that are here. I'll cite another strong reason why the U.S. coal mining sector is I think then better play than maybe some of the others, is that what we have is we have a workforce that's an in situ, in place workforce in the areas where coal is mined. And people like Mike Day, I know, is what is he, a second or third or maybe fourth generation coal miner. You don't have the labor issues that you might in other basins. It's I would throw out also say, and it's improved under this administration, the regulatory environment around coal is satisfactory, I would say, not perfect, but satisfactory compared maybe to other basins. The royalty structure, all that experience, the fact that we have obviously, for the most part, private mineral owners. There's sort of a market there that sort of sets that rate at a certain level vis-a-vis government dictating what that should be. And I know on federal lands here in this country, that's been a topic of discussion. Some of these other factors, I think, form the background of why the positive case for investing in U.S. assets. Maybe comment on that a little bit.
Yeah, look, I think for sure. I think you've nailed a couple of points there. I think, firstly, without getting into deep politics, the move towards support of the US coal industry over the last 12 months has been pretty clear, certainly within the US, but outside of the US as well. We see that, and I think some of the excellent work that the American Coal Council has done in terms of lobbying government for that support has been fantastic for those of us within the industry. There's definitely a lot of momentum behind that at the moment with the last raft of announcements out of the White House. So I think for an investor that certainly encourages you that there's support at all levels, not just at the corporate level. And I think, as you say, the generational miner thing is relevant. You look at most of the key coal locations in the US in terms of whether it's Central Appalachia, Northern Appalachia, or even Southern Appalachia. It doesn't feel that there's such a wide array of jobs outside of industry and so many choices for young graduates looking for their next employment as maybe there is in Australia, where there's much more of a fly in, fly out culture. So I think, look, that we touched a little bit on this on the panel in Miami the other week. I still think that that's something that regionally could be played on even more to try and encourage and retain talent. But those are definitely positives. I think also, as I said, if you look at the last 20 years, a lot of Australian mines have gone directly to end users. I think because the US has had this traditional domestic market, is still round numbers a third of total US met coal production. It's always had that as a primary market, and then through that an extension into the Atlantic market where there's a lot of familiarity. You've got European and South American buyers that are very, very familiar with US coals. I think, from my perspective, once you look beyond that, there's been a couple of trendsetters that have gone out into the vanguard and gone directly into Asian markets. But a lot of times there's been dependence on either sort of local agents or third parties. And again, as we discussed on the panel, in some cases, some of those intermediaries have tried to commoditize met coal, which you and I, as steel guys, know is not the case. You can't just move coal from one steel plant to another. Coke making technology and configuration, steel making technology, biomaking technology is very different case by case. And so, I think you can try and drive towards commoditization if you're sitting in the middle and you're disengaged and you've got no skin in the game. But ultimately, that's a volume game, and it's not necessarily generating the best margins, in my opinion, and it's certainly not necessarily to the best outcome for the miner. And I think we and certainly I, in terms of my role in heading the met coal desk here, understand that nobody knows the coal like the miner, and nobody knows the configuration and the operation like the end user. And you can support that, but it's far better to try and drive value through the supply chain and support one end or both ends and look for long term, because there is a lot of competition around, but if you develop a partnership which is strong, then you should cherish that. And I think, sometimes you can lose sight and try and maximize returns as one part of that supply chain in the short term. It's there's some pretty choppy waters out there, and I think if you work closer with people on a more transparent basis, that can bring a lot of advantages.
Yeah, a couple of things that you've said there. I just want to emphasize and kind of highlight for some of the listeners here who aren't fluent or as fluent as we are in this business. Not because we're smart, but because we've been doing it for a long time. I guess, or I'll speak
Definitely
for
not smart.
myself. But just to kind of step back a little bit, and this is a good sort of segue, I think, into a broader discussion on the markets and where U.S. met coal goes and whatnot. But yeah, Dave mentioned that here in the U.S. and in Canada, and the Canadian steel producers use U.S. metallurgical coal for producing coke, and yeah, we have annual pricing negotiations between the producers, all producers, and the consumers of metallurgical coal here. So that's unique. The rest of the world, the contracts are metallurgical coal are largely on a shorter term basis. From an investment perspective, somebody looking at a U.S. mining company should understand that there's a good sort of natural hedge in setting pricing for your product for a certain volume of your product at a fixed price for a term for a year. And so that's, just like you and I, and looking at our own portfolios, we like to be diversified, and that's one way of hedging, one way of diversification. So that's a very positive aspect of the U.S. coal side.
Yeah, Bill, maybe just to jump in on that, I think that's an excellent point you make, and one I should have mentioned myself. I think that is a unique thing for the North American market at the moment, or fairly unique. We're old enough, and well, you're grey enough, and I'm bold enough to remember when we used to do annual fixed price deals on the export side as well for everything. And then we transitioned after the first Australian flood in 2008. So we had this 1 in 100-year flood where the coal region was decimated and prices jumped to $300. And that was that was a price that was going to last for a year, and did. And then the following year we had the GFC, and the market collapsed as we had finished steel products that were lower in price than coal on its own, which, as you mentioned, coal and iron ore are 2/3 of an input cost for a steel company. So that wasn't a sustainable position, and there was a lot of structural changes, and we moved then into quarterly before we moved to index and spot-based pricing. So for the listeners that aren't familiar with that, even if you have a term contract on the export side, typically that price will rise and fall in line with the market, and there's not a huge amount of liquidity in the market to drive those indices. And so if you're investing in a mine in a market that doesn't have that strong domestic foothold, you're always, to a degree, at the mercy of where the market will move. And unlike a lot of other products, and partly because of the less commoditized nature of met coal, there isn't a strong and active futures and paper market against which you can hedge that risk. So if the market collapses or if the market rises, you've got 100% potentially locked into those pricing methodologies. Whereas in the US, you've still got that strong base where you've got, if you choose to, which most do, you've got that strong domestic commitment there. And that gives you some comfort because you've got annual pricing locked in on a calendar basis, and you know that you've got business there that's covering your costs. And so having that, as you say, exactly as a natural hedge, allows you to be a little bit bolder in some of your other decisions once you've got that to fall back on. And then really it's just a decision on a company by company basis how strongly they go after that domestic, because as we all know, if you lock everything in on a fixed price, then if we get rainfall in Australia, which we've just seen, and the market goes up significantly, then you miss the opportunity to play in that market. I think that's a very important point, but from an investor standpoint, certainly you've got a lot more confidence around where the forward market is if it's physically locked into a contract for 12 months.
Navajo Transitional Energy Company, NTEC, powers economic growth with dependable energy when it's needed most. Finding, developing, and delivering responsible energy solutions is at the core of our mission. NTEC is a caretaker with award-winning efforts for land reclamation, going the extra mile to protect the water, the air, the land, and its living creatures, because we believe in leaving things better than they were. NTEC empowers people and communities where we live and operate, giving back with time, resources, and financial support. Our award-winning operations for safety help ensure each employee goes home at night to their families. Protecting our people and our environment. That's NTEC, a world-class energy partner. Safety, stewardship, prosperity. Visit navenergy.com to learn more.
Yeah, and just for the listeners, just to give a perspective, when we talk about the seaborne trade of metallurgical coal, we're talking roughly, say 300 million tons, maybe a little bit more on that seaborne trade. Here in this country, we produce about 70 million tons. And I'll just kind of keep things in the metric world. That's actually maybe a little bit less than that, but okay, round number, 70 million tons. In this country, we consume, between the US and the Canadian, we consume about 15 million metric tons of metallurgical coal. And depending on the year, we're exporting 45, 50 million metric tons. So as Dave alluded to in his comments, that, we're, for every, say, 1 ton we consume, we're exporting 3 tons. And so metallurgical coal is a strong export play for us, and also that's important. We want to be strong exporters. We're long in met coal for the reasons that we talked about. Is that a lot of our steel is produced using electric arc furnace technology, but that's to the benefit of the broader market. The main competitive basin that the U.S. met coal has is in Australia. Dave, I think that number is about 120 million tons that they are exporting. So maybe you can pick up and just give us some figures as well.
Yeah, a little bit more than that. It's ranged over the last few years. It's been as high as sort of 170, 180 million tons. That's been the biggest player in the seaborne market for a long time. I think where trends have changed a little bit is if you go back to the earlier part of our careers, the phrase that was always used around the US was swing supplier. You had this stable, large base in Australia that was servicing the big traditional customers in Asia, and was also very well serviced into the Atlantic market as well. And you had the US that had its domestic base, it had its traditional export customers, particularly for high volatile coals, and then there was a kind of ramping up and down of production over time as supply and demand led to that. And we'd see the prices fall, and you'd see some of these mines move out of the market, and then when prices would rise, they'd come back in. I think now what we've seen is with the change in the landscape around Australia, there's obviously been a change in the royalty structure, and off the back of that, a number of companies have come out and said that they're less likely to invest long term in greenfield expansion in Australia. And as you've seen the rise in demand in, let's call them non-traditional markets, even though I know some of the US suppliers were supplying into those markets, but we've seen a huge ramp up, for example, in US coal into India. As that's happened, you've seen also a consolidation in the Indian steel market, and a huge amount of growth over the next couple of years. So the target is to get to 300 million tons by 2030. Considerable amount of that incremental growth is in the hands of 4 or 5 major steel producers. There's an understanding that there's a need to spread geographic risk. So, whereas before there was more opportunistic buying out of the US, I think now it's becoming a much more stable part of the portfolio to spread risk and to bring different types of coal into the mix as well. And so that for me is again one of the areas where I see a key role for people that want to invest and really dive into the US market. There's a huge opportunity to work with producers and represent that coal in the best way possible to those customers, and make sure that you're not just, as I said earlier, trying to commoditize and move volume, but you're really trying to technically market those products and develop a stable flow of business. Because once you've got that and you've got that certainty, even with the shrinkage in demand from Europe under decarbonisation, and with the challenges that Brazil's faced with steel imports from China, which have put a lot of pressure on Brazilian production, if you've got the confidence of those term contracts into growth markets, then that gives you a lot more comfort to look at expansion decisions yourself, rather than sitting there saying, well, I'm watching a shrinking Atlantic market and I'm not really playing in this market over here. What do I do? I think it's the time to embrace that. And I think that for me is a key thing we're starting to see evolve, and I think probably more needs to happen. At times those are not going to be the best returning markets in terms of revenue. There's a natural freight offset that you have to overcome versus Australia into those markets, or versus Indonesia into those markets, or other markets in Asia. And I think from also from the from the end user perspective, there's got to be an understanding that some of these coals are a little bit different. The mineral matter that went into those coals and the conditions under which they were formed over hundreds of millions of years is different. And so there's got to be an understanding that we've got to be a little bit more flexible technically. But if you can get a meeting of the minds of that, then that can reposition everything. And I think we talked extensively about high vol in particular in Miami. So people say this to me all the time. Why would Vitol go and debt finance a high vol producer to buy another high vol producer? And does that not concern you with the growth in output for high volatile coal out of the US, particularly with a number of the major scale, long wall, lower cost producers? And I think two things there. That comes down to selection of partners. I think from our case, Mike Day and Eagle Summit's very diversified portfolio across thermal and met, coupled with the scale. They're a 40 million ton miner. They're one of the top 5 coal producers in the US. So I think from that perspective, we're comfortable with the choice of partner. And then I think it also comes down to the partner's coal. And we believe that those coals within the portfolio offer certain traits that we know, because of the work we do with those customers on other coal products we know are valued. It's really a case of then driving those points technically as well as commercially. You don't just look at a high vol as a high vol. If it's a high vol that's got low ash and high CSR, then you find the customers that value that, and you're not necessarily targeting other high vol. You're trying to work with people to change the blend rather than just substitute into the blend. And I think that's a key point. So you can never compete with volume and price, head to head if you're a smaller producer and your costs are higher. But then you've got to box clever and just think differently and outside the box.
True, but I used to hate, and I still hate, and I think it's completely invalid now. This comment that the U.S. is a swing supplier in the met market. I've always felt that for certain basins, for sure, it was a key and valuable customer. I've had European coke makers and down in South America tell me that they there's no way they could live without certain types of U.S. coals. And we're seeing less and less of that kind of swinging when we're talking about let's say the home export markets, which are Europe and South America. Another point is that from a competitive that you made is it's just a fact that that the U.S. used to be that the Australian or the big, huge volume producers were on the left side of the cost curve. And for the most part, the U.S. guys, with maybe the exception of a mine or two, were on further to the right. Well, now, especially because of let's say the austere royalty structure in Australia, other reasons. I mean, the lowest cost U.S. mines are now to the left of the cost curve, even further than some of the competitive mines out of Australia. That dynamic has changed.
Yeah, that's true, and I think that's another good point you make. The U.S. mining fraternity has been used to dealing with smaller, deeper mines for a long time, and in the on the open cut side, in dealing with smaller operations. And traditionally, you see in Australia, largely driven by topography. You've got a lot of mountains in the way in West Virginia that and Virginia and Kentucky that make that more challenging. Whereas you've got a lot of open flat space in Australia, which has led itself to these much larger scale operations where you can put in a lot of larger equipment. So your capex costs are higher, but your opex costs are lower. And then you've obviously those mines have been in existence for a long time now. So those opex those capex equipment have been have obviously been paid off over time. And so you've had a much lower cost base. But now what we're seeing is thinner seams, increasing strip ratios in Australia, the royalty structure, a lot of escalation in costs. Certainly if you go back 20 years to sort of 10 years ago, you saw a big increase in costs of employment as well. So all of those things have kind of rebalanced the playing field a little bit. And I think, look, I mean, this is obviously a US focused podcast. I don't want to certainly bash the Australians. We do a lot of work there. There's a lot of excellent mines and exceptionally good coals over there as well. And again, all of the opportunities that we're talking about exist, over there as well. It's a little bit more difficult because of the more consolidated nature of the market. Make no mistake, all of the challenges that the US coal industry faces are faced everywhere else as well. And so, I think the term swing supplier being applicable to the US and the terms of low cost producer being applicable to Australia have changed over the last, certainly the last 5 years and probably further back than that. And it's now a more level playing field. It's just geographically, you've got bigger ports in Australia and shorter sailing times. So, that allows for economies of scale on logistics. And that's a real headache. That's for the US. That's something that is not so easy to address. So then again, you've got to be a little bit clever about what you do and how you do it.
Yeah, that's right. I would agree that over the past few years, the playing field has leveled. Uh, as you said, and it's true. It's in most markets. I would say the extra logistics cost, the ocean freight rate cost to get coal from the U.S. to Asia versus Australia to Asia, you're talking about a sort of a $20, $25, even $30 per metric ton sort of hurdle to get across, which is difficult. But say for some of these reasons that you've elaborated on, I think it's become easier for the U.S. guys. The whole technical marketing aspect of metallurgical coal is really important. And so as you've touched on, and as we've said here, of course the U.S. guys, they're captive to U.S. metallurgical coal, so they know quite well how to use U.S. metallurgical coals. And maybe someday we can have a kind of a geek out session on metallurgical coal qualities and why that's so. But they're very familiar with the U.S. met coals, and they can make perfectly good coke using the met coals that are right here accessible. The Europeans, the Brazilians, Argentinians, the South Americans are I'll say also very well versed in using U.S. coals, but still have the opportunity to use Australian coals because they're situated in areas where they can also access Australian coals on a delivered cost basis at a almost, I won't say equal price, but the disadvantage isn't so big as it is for U.S. coals going to Asia. And then, so now we step into the role of a metallurgical coal marketing person in positioning U.S. coals to areas like India, like China, like other countries in Southeast Asia. And I'll put up this sheet, and there's nothing on it. Okay, but this is an 8x12 sheet of paper. Yeah, for you, for Dave, for you, it's an A4 sheet of paper, or sort of an A4 sheet of paper.
That wouldn't be fitting in my printer.
But for metallurgical coal, when you go to talk to an end user of metallurgical coal, this entire sheet is filled up with numbers and words that are about on a 10-point font. And, it's very much a technical sale, which kind of goes into your point that the metallurgical coal is, in my view, it's impossible to commoditize that. There can be a big debate about that for certain grades of coals, but each metallurgical coal is different. They have their own fingerprint, just like you and I have our own fingerprints. And technicians are very, very careful about what types of metallurgical coal they put in their coke battery, because back again, coke is probably the highest cost input into the blast furnace iron making process. And if you mess up your coke, you mess up your iron. And if you mess up your iron, you mess up your blast furnace. And if a blast furnace goes down, as technological as coal mining is, steel making is like umpteen times more, I would say. But if a blast furnace goes down, it costs probably more than $1 million a day to keep it running while you figure out what's going on. So, or heated while you figure out what's going on. So With that long-winded explanation, yeah, tell me a little bit about sort of your view, having had feet in all these your feet planted in all these markets, on sort of the learning and the adoption of U.S. met coals in, say, in the Asian market, which is where the growth is.
Yeah, look, I think you and I probably went through the same school of hard knocks, except you heard it in a Pittsburgh accent of what a yin's doing, and I heard it in a broad Yorkshire accent or a South Wales accent or a Dutch accent, and then, well, actually Indian. You, as a commercial guy, you can go and present an opportunity to a coke oven manager that's going to save him $3 to $5 a ton, on paper, and then he points out that if you wreck his coke ovens or his blast furnace, you're going to cost him £1 million a day. So, yeah, you kind of then learn very quickly to make sure you're representing the right things in the right way. I think the worst thing you can do, particularly if you're not a miner, I think the worst thing you can do is go and see a customer and not understand the product and the operation that you're representing. And I mean, if it's just a coal, certainly the coal. But if you've got more skin in the game, then not understanding the operation, you've got to be able to articulate that, because it's a confidence vote at the end of the day. You can have the best coal in the world, but if you go and speak to the larger, lower risk customers to deal with globally, whether that's in Europe, whether that's in India, whether that's in China, whether that's in Brazil, they are not just investing in buying that coal as a one-off normally, unless it's extenuating circumstances. They're looking at, how does this replace something in my blend for the long term? Because saving a couple of bucks once is not something they're focused on. It's about, how do I deliver value over a period of time. I think you need to understand the operations, you need to understand the logistics and the products, and then if you really want to work with someone, understand their operations as well, and what you can deliver. And then it's really just a case of, if you understand what they're looking for and what their purchasing behavior typically is, and you've never got a perfect lens on this, but you can figure enough stuff out. It's about presenting something that you think fits and does something for that customer as part of the cake mix, and you're just contributing to the total pie. So I think understand the customer, and then there'll be different drivers for different people in different markets. For some, that might be something to do with the actual the coal itself and the coal quality. For others, it might be around what you can do in terms of infrastructure, storage, etc. But I think the worst thing you can do is not understand the coal and present something, or over elaborate or over promise, and then that not perform. And to my mind, this has been less of an issue for Australia, because there's been a longer track record with all customers. Whereas I think for the US, in some cases, there have been people that have overpromised and underdelivered. And the problem is that then creates a bad rap for everybody that's supplying a similar coal. And the only way that you can overcome that is in a confident approach about why your business partner, if that's applicable, and why that product is different, and what you've done to validate that. And again, we talked about this in at Brosnan Forest, and a little bit at the Miami Forum the other week. It's about presenting those those products technically, and making sure that you've got the the analysis to back that up. And the one that I always go to is in particular is CSR. And I know that's not going to mean everything to every listener, but as a very quick 10-second summary, CSR is a key driver in value of most metallurgical coals. The higher the number, the better. And it normally gives a very quick check for most consumers of how that coke is going to perform in certain roles how that coal is going to perform in certain roles in the coke ovens. And what you tend to find is there's a huge familiarity with the domestic market in the US around CSR, because they've been using these coals for decades, and they measure things slightly differently. In the Atlantic market, there's been a lot of widespread usage of US coals, and they understand that. But if you go to India, and if you go to Indonesia, and you go to certain other markets, there's less familiarity with US coals, particularly for emerging and sort of rapidly growing suppliers and end users. And as a result, they put a lot more credence on CSR. And if that test work hasn't been done and you kind of guesstimate it, or you run it on calculations that are designed around coals from other basins and it's thrown up a false number, that's going to cause a problem. So you've got to be very, very careful that you present not just all of the data, but you present the right data in the correct way. And, I would say, sort of independent validation of that is pretty key. And so from
Yeah.
my mind, that's one thing I always try and do, is make sure that you've fully validated that product, and you can stand by that specification sheet. You can't be responsible for how people use that, and you can't be responsible for what other coals are using in a blend and what the outcome is. But you don't want to be in a position where you present something, you sell somebody something, and then they come back and say that's fundamentally wrong,
Yes.
because
Yes.
that's a nightmare.
Yeah, and the process of getting a metallurgical coal qualified in most cases is extensive. It's measured in months and sometimes
Yeah,
even years.
yeah,
You send a sample, you go there, you talk about the quality, you talk to the coke maker, you understand kind of what their wants and needs are. You think about how your coal might fit. When I used to sell coal, metallurgical coal, and I still do, but when I was responsible for a large volume of coal, and my sons would ask me what I do, and I say I have 2-3 word job descriptions. I sell coal and I make matches. And in order to make the match, you really have to understand, what you're selling. You have to understand, you have to put yourself in the chair of your customer. I would say a technician evaluating metallurgical coal is and it's just as important to them as, say, a buyer of a key component of a BMW or something like that. I mean, you really have to know that this thing is going to fit into your product, and there's work to do in the Asian market, and getting folks to really understand the value of U.S. coals and the value that it can bring to your blend. And we maybe we can have another session and geek out and go through all this. I mean, if anybody wants to know, Emily can let us know if that's something that we should do. But I really do believe that the adoption and the understanding in the Asian market of U.S. coals has grown, but I think that there's a lot of work to do. I'll talk a little bit about the Japanese. Japanese are sort of long game thinkers, and the Japanese are focused, buyers are focused on diversification of supply, because that's also important. And they've been using and understanding how to use U.S. coals for a long time. And they traditionally haven't swung in and out. And starting to see that adoption in these other markets, in India and Indonesia and in other places. And so, having people like you, Dave, and those who are, really solid and have strong backgrounds, both as buyers of met coal and sellers, representing coals out of the U.S. is fantastic. And you really have to be a pro, and you are a pro in presenting these coals to these buyers, because it's so important.
That's very kind, Bill. But I think you're always learning in this game. There's always something new to learn, and I think it's increasingly important to be more technically proficient and not just commercial. And so there you should never lose sight of the fact that there's always something new to learn, and that adds another string to your bow. I think, as we've said throughout, it's an exciting time for met coal. Whether you're an Australian producer, whether you're in Indonesia, whether you're in Mongolia, whether you're in Colombia, US, Canada, there's huge changes, shifting trade flows, a lot of opportunity out there, but there's certainly challenges as well. But from my mind, I think it's really heartening to see the direction that the US is traveling in terms of top down support for mining and for coal. I think again the work that lobbyists and groups such as the ACC have had in terms of playing a role in that have been fantastic. Vitol believes that's why we've moved from our comfort zone of traditional products into metals and mining, and why they've been very, very keen to set up the met coal desk, and why we've made those plays into the US market and others. So we're ready to take up the challenge and play our part in the role. And it's been an exciting 10 months for me since I joined, and looking forward to the next couple of years.
Dave, thanks so much. At this point, I think we'll give it a wrap here. And thanks so much for taking the time to join us on this podcast. Thanks so much for your participation and advocacy of U.S. coals throughout your career. Thank you for Vitol and their willingness to kind of let you participate on this, and also to for their support of the American Coal Council. Last but not least, thank you for your good friendship over the years. You know, we look forward to seeing you here. I know you come here often, and next time you're up and around and it's snowing or not snowing, you're always welcome. And maybe we can also, try to do something in the future, maybe to get more into technical aspects. I don't know what, but at this point, I'll give you a virtual fist bump.
Appreciate
Thanks
it.
much.
Thanks to you.
Yeah.
Thanks to Emily and the ACC as well. I think you guys are doing an excellent job, and it's a pleasure to support in Miami and a pleasure to support with this. And anything I can do to help, please let me know.
Thank you, Dave.
Thanks a lot. Cheers.
Dave, thank you so much for joining us today. I really appreciate you taking the time to share your insights and perspective. It's clear there's a lot of opportunity ahead for metallurgical coal, and your experience across the global market brings tremendous value to this conversation. And thank you to all of you for tuning in to Coal Nation. Before we go, I'd like to once again thank our sponsor for today's episode, Navajo Transitional Energy Company, NTEC. NTEC is an American Coal Council member powering economic growth with dependable energy when it's needed most. To learn more, visit navenergy.com. Thanks again for listening, and we'll see you next time on Coal Nation.
Thank you for tuning in to Coal Nation, the official podcast of the American Coal Council. Our mission is to share coal's story and showcase its critical role in powering our economy and supporting our way of life. If you enjoyed today's conversation, be sure to subscribe. The American Coal Council represents members across the entire coal supply chain and advocates tirelessly for our vital industry. There is strength in numbers, and we'd love for you to be part of the conversation. By joining ACC, you gain exclusive access to the latest industry developments, a voice in our work that can benefit your business, and incredible networking opportunities. To learn more, visit www.americancoalcouncil.org. Together, we are shaping the future of coal, and it's exciting. Thanks for tuning in, and we'll see you next time.